I will tell you someone who is second-guessing the Fed, and that is the Wall Street Journal in the Heard on the Street column this morning. Fed missteps with bond message. Some investors are blaming last year's market rout on bond sales by the Federal Reserve, but the central bank's apparent admittance of guilt could pose bigger problems than any bond sale. What do you think of that?
Well, a couple of pieces. So the part that I liked about Powell's stance was perhaps putting a halt on increasing the Fed funds rate. Not a terrible idea. I mean, neutral's probably 1% above inflation. We're close to 2%, so we're almost at 3%. That's not a bad idea. The continuing unwind of the balance sheet's a good idea because if we're looking for dry powder, we have to get normalization across the curve and get rid of the vestiges of QE. So the part that gives me a little bit of pause is the notion that the unwind of the balance sheet might stop in the second half of the year, too.
Craig, where do you stand on that, and what do you think it's going to do to stocks?
So it's interesting. If you look at the stocks I cover, the brokers and asset managers, I mean, really simply, they went straight down in December, and they came straight back up. They're right where they were before, so it's almost like nothing happened. But the market was looking for the Fed to go on hold, and that's exactly what happened. But there's a whole bunch of other macro events. You know, Brexit, China trade, Mueller report. I mean, there's a whole bunch of other events out there that could push it either way. But we're focused on the economy. Economic growth is sort of 2% plus. That's actually good for my stocks.
What do you think the second half of the year actually looks like?
Second half?
Second half.
I think it's going to be perfectly reasonable. I mean,
so everybody who's screaming that we're going to have problems second half.
Well, let's look at the data so far. It's coming in quite fine.
Right.
You know, 304,000 new jobs, 2.2% CPI ex the non-core pieces. That's fine. Even ISM manufacturing up to 56.6. I mean, the only bad number we've had recently was retail sales, down 1.8%. But that's probably a bad number. If Walmart didn't give us enough indication that that was probably a bad number, as another indication of things that happened in the shutdown, the e-commerce number is going to be 3 weeks late. So there's weird numbers there. So most of the data is pretty good, and I think that continues in the second half.
You look at your guys. I mean, the companies you cover. You think their second half is actually going to be as good?
I think it's a tale of two cities. If you look at the brokers and the ones I cover, they're putting up really strong organic growth. This is Ameritrade, Schwab. I mean, they're growing anywhere from 4 to 10% before the market. So they're benefiting from a bunch of secular trends. If you look at the asset management world, alternative firms are raising lots of assets. Blackstone, Carlyle, Apollo. ETFs are raising lots of assets. That's BlackRock. But in the middle, there's a little bit of hollowing out. So I think that trend continues this year and probably for actually a few more years after that.
But that has nothing to do with where the economy stands today. That's just a larger trend, which is to say people like alternatives better. They either want to go into a completely alternative space or they want to just live in ETFs. They don't want to just have their money managed the way we used to be.
Well, there's a few indicators. I mean, remember, there's $2.1 trillion of dry powder sitting on the sidelines with private equity. I mean, does that stop the market in January and put a floor? Maybe. When that's there, you got a backstop on the market. Also, if you look at my retail brokers and you follow the cash balances of what retail's doing, there's a correlation there also with the economy. But cash balances are really low, and what that means is there's not a lot of cash left to come out of the sidelines and help the market on the retail side.
So when you look at, that's interesting, when you look at the retail investor that's in Ameritrade and you look at their cash balances, do you think that's a sign of how confident they are?
Yeah.
Is that a confidence signal? What is that?
It is a confidence signal, but it's also a contrarian signal. So where we sit today in terms of cash balances, it looks like 2000. It looks like 2007.
It's terrible.
It's terrible. Maybe we have a few more years to go. But when you look at the magnitude of the decline, we're sitting here at record low levels of cash in the balance sheets of retail investors.
Okay, Simeon, that should scare you.
So here's my one concern. Margins are now higher than their pre-crisis peak. And we're having the back end of the tax cut. So in other words, the corporate tax cuts are now going to go to consumers in the form of price. So there's a little bit of margin pressure that may start to emerge, perhaps as early as the second half. In terms of approaches to that, rules-based strategies that identify companies that have increased their dividends, quality stocks that can fight against that and have some pricing power might make a good idea.
Right, before we let you go, so I'm fascinated on this cash balances issue. Do you want to own those stocks then? If you're telling me that this is 2000, 2007, you'd say to yourself, okay, sell everything.
It's so you actually do, because they make most of their money now on client cash sweep. That's where E-Trade, Schwab, Ameritrade make 60, 70% of their profits. So if cash balances trough and move higher, they actually have this very nice counter-cyclical buffer that will help the stock. In 2008, it wasn't a bad year for the retail brokers. It was a bad year for everything else, but their earnings were actually strong in 2008.